For more analysis on the US debt concerns and the mass sell-off is Professor Geoffrey Garrett, the CEO of the US Study Centre. Of course, Howard Coleman from Team Invest is still with us, as is Chris Weston from IG Markets in Melbourne. Professor Garrett, I might quickly start with you, though. Firstly, thanks very much for your time. Just looking at the US economy, lots of talk and talk growing a lot louder about a double dip. Some traders, though, I've heard, suggested the US never actually got out of the first recession.
Yeah, I think it's fair to say that the US recovery after 2009 was at best tepid, and now it looks like it's flatlining or in negative direction. Unemployment, housing, consumer confidence, consumer spending, all bad. I think the interesting thing about this week is it tells us really that the debt ceiling crisis that we were so obsessed with was probably more a sideshow than the real game. The real game's about the real economy, and the thing we're worried about is that Washington doesn't seem to be able to act.
Is that the problem here? You've almost got this almost hash job, if you like, done from the politicians. On the one side, you have the very leftist Democrats not wanting to see any cuts to the likes of the obscene amount of funding that you're seeing in Medicare and Social Security. And on the other side, you've got the ultra Republican Tea Party who just want pretty much no government intervention at all, and there's no middle ground.
No, there's no middle ground. You know, Barack Obama and the Speaker of the House, John Boehner, tried to find it, and they both got burned earlier this week. So, you know, the stuff that was in the debt ceiling deal as it was ultimately done, the Tea Party liked. I just don't think it's so relevant. For example, they're going to get a vote on a balanced budget amendment to the US Constitution. That's got no chance of passing, but the Tea Party wants it. You know, the bigger story, I think, is can we now get some more stimulus out of Washington? And I don't think you can look to Congress and the President for that. You've probably got to look to the Fed. Is the Fed going to belly up to the bar with a QE3? I think that's the big question today.
Chris Weston from IG Markets, let's try and answer that question. I mean, do you see quantitative easing 3 as firming in odds?
Well, it's certainly getting a bit more credence of late, and we've seen ex-Fed officials talking about it in the last couple of days. I think the fact that gold price has been moving up as well is probably pricing that in to a degree. I think if you look at the break-even rate between 10-year treasuries and Treasury-inflated protection security tips, there's still an element of inflation that's being priced into the market. And remember, QE2 was there designed to pump up asset prices and get rid of the deflation that they were seeing in the market. So there probably isn't quite the deflation in the market necessary to really give a clear message about QE3 at the moment, but we are starting to see that mentality creep in. Stock prices are obviously falling. We might start seeing retail spending being crimped as people start to think perhaps we can buy prices in the real, on the high street, on Main Street at a cheaper level. So that's one situation that's probably holding them back a little bit. But Bernanke at the moment, he studied the 1930s, and he's not going to sit by and just watch this market plummet. He has to do something, and there isn't a huge amount he can do, to be fair, with the exception of perhaps changing the language and looking to reinflate these asset prices, which could obviously give the consumer a feeling that they've probably got slightly better wealth through their stock portfolios. But it has been getting the rounds, and the deterioration we've seen in the economy is getting few people to believe that perhaps this is going to happen.
Howard Coleman, I mean, the idea of quantitative easing 3. I imagine that the markets like the idea. The past 2 were great for commodity prices and stock prices. It did next to nothing for the economy, though.
Yes, and in fact, they're not good for stock prices in the long term either. So they're only good for stock prices in the short term. Yeah, I certainly think there's a likelihood of QE3, particularly with Bernanke's background in having studied the Great Depression. But the one big difference we have between now and the Great Depression is at the beginning of the Great Depression, government debt was almost zero. Debt to GDP in all the developed countries was less than 10%. In fact, a 5% debt to GDP, government debt to GDP in those days, was considered quite horrendous. That's not the case now. The second thing is government spending as a proportion of the American economy was only 3 or 4%, federal government spending. Franklin Delano Roosevelt pushed that up to 10% to inflate the economy. Well, government spending in the US is now 25% of the economy. It's a lot harder to just push it up than it was then. But I certainly do agree with both what Chris and Savant said about is this a double dip? We've been talking with our Team Invest members in our meetings for the last 2 years. about the fact that there are two kinds of recessions that you get in the world. The normal cyclical recessions caused generally by economies just getting beyond themselves, and those caused by asset price bubbles. Japan was an asset price bubble recession cause in 1990, and they've had 20 years trying to get themselves out of this mess. We've been talking with our Team Invest members that the United States was not going to get out of this mess in a hurry. So a double dip to us is really part of the original dip. It's not a second dip, but that doesn't mean that you can't make very good profits out of the stock market. And a lot of people in the 1929 to 37 recession, Great Depression, got extraordinarily wealthy by picking the right kind of companies that had growing earnings per share and buying them when everybody else was fleeing the markets.
We'll go back to a little bit later in the show about how to potentially play this market, but I wanted to go back to Professor Garrett and talk about the political side of these things, Professor. In particular, President Obama, a very clear strategy of his was to give a bit of space to the Republicans, in particular the Tea Party. You'd have to assume to hope that they'd somehow, take enough rope and hang themselves. That has proved to be the economy that looks like it's hung itself.
Yeah, I think that is a really important story. Barack Obama thought that the country would view the Tea Party as crazy. What he didn't bargain on was that the Tea Party would be willing to throw the steering wheel out the window and say, we don't care if the economy tanks and we don't care if we lose our jobs, we're going to do the right thing. But I think the debt and deficit talk just has to be put in perspective. Yes, the US is in far worse shape today in terms of debt and deficit than it was in the 1930s. But it's in much better shape than Western Europe is. I was just looking at the debt statistics today. Net US public debt is lower than French net public debt. No one's talking about a fiscal crisis in France. And obviously the world, led by the Chinese, are still willing to lend the US government money at unbelievably low interest rates. The 10-year Italian bond is trading above 6%. The 10-year Greek bond is at above 15%. It's now under 2.5% in the US. So I think that the markets are certainly allowing the US to borrow more money, or maybe for the Fed to put more money into the system. We just have this political gridlock that doesn't seem to want to support that.
All right, Professor, unfortunately we do have to leave it there, but thanks very much for your time today on what is no doubt a very busy day.